All right, good afternoon, everybody. This is Event Trader. It's November 16th, and I am joined, of course, by chart trader Brett Manning for the latest
Yo,
edition of the Sentiment and Flow Show. So, without any further ado, Brett, how are you doing today, my man?
pretty poor. I
Yeah,
mean, I'm I've got, for people who don't know, I've got triplets in first grade, and basically that means that and they're all in separate first grade classes
mm,
at a big elementary school where there's only three first grade classes, which means my household is like a
petri
capturing net
dish.
for every single germ in the district. So
Yeah, well,
yeah,
glad you could
that's like.
glad you could be on with us. It is cold season, of
I'm
course, coming
soldiering
in, right?
through.
So,
That's what I'm doing. I'm soldiering through.
nice, soldiering through with the long and the Q's, right? So,
Indeed.
why don't you update us on that trade for right now?
Well, I mean, yesterday I said I thought it would break down to 15,775 as my sort of. I think when you have a sentiment, we'll talk about the sentiment shift. But when you have something this rapid and this powerful, you start to see it. Like that a lot of people are changing. It's like a whole bunch of people who had on like brown tinted glasses, getting those glasses ripped off their face by some outside force, and then some rosy colored glasses get jammed in their place. And suddenly people are going, whoa, actually, hey, this looks pretty good. And when you get that kind of transition that's really fast and abrupt, like people aren't positioned, but their opinions have changed. And so there's a competition for exposure. And so it makes pullbacks really shallow. Like you get this leap, and it's just really tough to get a deep pullback because you've kind of gone, like we're going to show in a little bit. Like fund managers have gone from being underweight to overweight for the first time in like 18 months, and that's what they report. Who knows what their positioning is? This is all self-report, but individual investors have shifted their mindset too. But it's all been very rapid, and I think you've got a competition for exposure right now, and a pullback, like what defines a pullback, is a pretty variable idea. And especially when people are competing for exposure. So I kind of have a high tight kind of idea in terms of the chasing bid, and I want this sort of Elliott 4 of 3 kind of point, which is where I pointed out yesterday with the 15,775. And when we ducked under 15,800 today, we got like 15,796, I think. There were two 1 minute bars with giant spikes in volume on that, and I figured that pretty much, you know, was that pullback. It didn't quite get to where I thought it would go. Couldn't get that extra 20 points. And then the pattern just set up, off that volume spikes, and so we bought, and we got a nice 80 90 points up on it, kind of sitting in the range right now. And it's been a pretty whippy day, but I mean it certainly did what I like it to do, which is I like to be right quickly rather than have to be in a war. And in a setup
Right.
like that, that should happen. So that's why I throw the ball away a lot. When I feel like I'm not right quickly, I just find that my long term sample is better. But this is right quickly, leapt right up, and I've already taken 3 times. Somebody asked, "Are we going to let the last one come back?" Man, this is the runner. Probably will if it does.
Yeah. So we'll continue to monitor that trade. Definitely see if we can find any buyers above 15,900, which
Yeah.
is
And by the
kind of
way,
been
the
the
large sample data, if you run it, it's good to have the runner idea. Like you'll get occasionally like a 500 points you didn't expect. Like just let some piece of it go, and over the large sample, over any 100 trades, it works out in your favor.
yeah. Keeping an eye to President Biden speaking right now, so we're just watching to see if he says anything that's going to disrupt the markets. So, all right, Brett, let's break into this version of the Sentiment and Flow show then. We're just going to give some of the overall market characteristics. Investor anxiety does remain around the implications of higher rates for company operations and sovereign debt. You've definitely seen that in some of the earnings responses where misses have been hit pretty hard. Cisco, Palo Alto, Walmart being the latest version. Doesn't even have to be amiss per se, but it just kind of points to some of the concern that's out there in the markets on what kind of impact the higher rates are having on the overall market. But as Brett and I are going to get into, this isn't really the dynamic that we see driving that end of the year rally. Single stock shorts have increased 14 straight weeks for the longest streak on record.
Where'd you get that data point?
That data point would have come from a Goldman Sachs note on Monday. So
Okay.
my assumption is that some of that's been shaken out at this point. Let's not forget, we basically get short data, like the strong data
Yeah.
points
Yeah.
at the middle of the month. So today's obviously the 16th. So I would
Yeah.
think
They
that
can't
that's
violate
probably
that,
going to
right?
be,
So that's probably
but
that lag.
it goes to the point of, for the last 14 weeks, that would be through that dire September, August, September, October period, right?
In other words, it's the stage setting environment for this rally.
Correct. So, that's one of the elements that's been out there. Sentiment has been volatile. We see it on the upswing for now, and we'll talk about the AAII in a second. IT now makes up 29% of the market, which matches the 2000, 2001 highs. So
Wow.
that continues to be a big driver, obviously. NASDAQ's outperformed the Russell by 6% over the last couple of weeks. That's the largest spread in 8 months. So certainly concentration going on in the NASDAQ. We've had the MGK, the mega cap growth, breaking out. So certainly the generals in this market remain strong. Markets near all-time highs despite rates being much higher. No equity risk premium out there. Soft landing remains the general expectation. So it's interesting to see some of the recent rattling going on weaker econ data. Conviction that the Fed is done hiking. Portfolio underperformance heading into the end of the year. And that's going to be really one of the main crux of this
Yes.
this discussion. We got a slide coming up that's going to kind of highlight some of this and some of the reason why, even though the econ data could come in a little bit weaker and perhaps yields are faltering because of those concerns, there's still the potential for a run into the end of the year, and we'll get into that in the show. And then bullish sentiment obviously perking up, money coming in off the sidelines. Does this mean that there's less upside? So these are some of the things we'll discuss in today's show and break into it in a little bit more detail going forward. So as per usual, we will start with the AAII data here. And as you can see, two prints of 40, over 40 in a row. That's the first time we've seen that, Brett. You got to go back to that run that we had in July and August, which, of course, helped facilitate that rally that we got going into about the middle of August there, as more and more people started pulling off the sidelines. What's interesting is bearish sentiment actually went up, and this is going to kind of factor into some of the short sentiment that's helping provide some of the kindling for this. And then just kind of going through this real quick, Brett, and then I'll let you let you build on it. One of the things that we would point out is the bullish 8-week moving average. It's not that high right now at the moment, so there is room for some more upside. You can see we had a run of in the 40s. This is again the 8-week moving average in August. And then naturally, we had that negative run all through September and October and the first part of November, where we were seeing some very dour sentiment. But now we're starting to see that pick up, and that's pretty evident. In the two bull bear spread readings that we got with the 15%. You got to go all the way back to the beginning of July, the last time we had that going on. So, Brett, what's your interpretation of this data that we're seeing right now?
Well, as far as AAII itself, I don't see it as too significant. I mean, we've talked about this a lot of times. Like, it really needs to be persistently at an extreme for a period of 5 to 10 weeks to get to be particularly important. In my experience, and I've got a lot of experience with this survey going back very many years, and usually you don't see, like, it doesn't become a contrarian, and it's also much more of a contrarian signal the other way, in my experience. In other words, persistent bearishness is a buy signal more so than persistent bullishness is a sell signal. You could see there's been plenty of bull markets where it hits extremes for a period of time, midway through the bull market, and just kind of keeps on rolling. And that's the asymmetry to the equities market. If it was a currency market or a commodities market, there's a lot more symmetry in terms of positioning on either side of the market than there is in the equities market, which is more of a 90-10 kind of situation. And as long as people have dry powder, as long as there's available leverage, like bullishness is not necessarily a contrarian signal. I get worried when we start to see options data get overwhelming in that direction, more so than something like this, like people just feeling positive about the market.
Especially these days where this could turn on a dime, right? I mean, just pretty
Yeah.
evident on that the last couple of
Well, people have been whipped around real
weeks,
bad. Yeah, right.
right? I mean, we went from 40 to 24 to 43 in the span of 6 weeks. So
Yeah, and I mean, I don't think that's too aberrant, but it's been more. I think, and we I think we talked about this last time or the time before, that there's this pervasive sense to me, that there's this boogeyman in the market, right now, where if things go really well, people get bullish, but the second you have that one little kind of crack in the mirror moment, that second there's some kind of red flag, during this period over the last year or so, it just seems like everybody gets so bearish so fast. Like the second we have a 2% down day, it's like, oh, that's it. End of the world's here now. Like, I thought it was
it is
good, but nope, it's all over.
it is amazing. We could run up 15% in a week and
Yeah,
then
you
have a
get that
2%
one
drop
red
down and
flag
everyone's
moment.
freaking out.
Yeah, that one wrong no, right, exactly. And it's just there's something about this current context. And I don't know whether it's the political situation or just some kind of like zeitgeist problem at a socio-cultural level. I don't know
I
what
think
it
it's
is.
a zeitgeist problem, Brett, where everybody wants to be the one to tell you how bad everything is and how
It
wrong
feels like
everybody
that,
else
right?
is.
Yeah.
That's how I view it. I mean, we've talked a lot about it with the bubble of bearish sentiment. It's just it just goes on with the current world backdrop, I feel.
But there's this foundation of this bedrock of support in the market where there's like this certain amount of shares you get down to and nobody's going to sell them and it's stuck there. Like there's this that it's mixed up against this environment of like, well, we're going to have the Jetsons in 10 years, and I don't want to sell my Microsoft ahead of that. Like there's this kind of sense of a tremendous amount of confidence about extraordinary technological breakthroughs that are just going to come rolling out. But yet, the world's going to hell. And this just kind of tension between those perspectives leads people to kind of get really short term or intermediate term very bearish. And then there's a certain percentage of holdings that are just not for sale at any price. And we keep getting to this. Everybody's super short, borrowing shares from other people to sell, but they won't sell even, their own portfolios. And there's just everybody gets loaded up on puts. And then, it turns out to not be so bad. And we get this just big leap like we saw in
Yeah.
April and May. And we're seeing now. And we talked about this last time. We had this enormous buy signals going on, but the market couldn't quite find its bottom. But we're sitting here looking at these, hedge funds more net short than they have been in 4 years. And the 10-day moving average of the put call ratio is sitting at 1.2. And these things are inviolable kind of rules of like, there's no way a bear market starts like that. And I was really surprised we got down to the 4,200 level and below. Like I was really starting to doubt my basic precepts. And then this rally is kind of the reaction to that. Like we really seems to me like we got to a place basically that was unsustainable on the downside, and the snapback is vicious.
Yeah, I mean, just a 41-point swing in the bull bear spread from November 2nd to the 9th tells you everything that you need. I'd have to go back and check
Yeah,
to see
right.
when the last time. Quick market update. We are inching higher here at following Biden's speech, moving up towards those session highs. Definitely feels like the algo is trying to squeeze us up here right at the moment. So we'll see if we could get through 15,900. But perhaps people were waiting for that Biden speech to pass just in case there is any sort of red flags in the commentary. But positive reaction following President Biden's comments. So we'll continue to monitor that as we get closer to 15,900 in the Nasdaq. All right, here's one slide from the fund manager survey, Brett, where we're talking about that bearish sentiment. It still remains, but no longer at the extreme bearishness at the moment here. You can see it's kind of had a steady move higher here.
But what's just amazing about this chart is it got below the financial crisis.
Yeah.
Like, how on earth
the Silicon Valley
sit here
crisis
in this world today and think that it's even remotely comparable to what we were going through then? You know what I mean?
Yeah.
Like, it just, what? We got to do is set a 5% GDP number.
Yeah, I mean, I think certainly probably some of the geopolitical events that have occurred, you start getting people thinking on that. But again, that just
but that was 1929 back then. I mean, that was some stuff. 2008, that was some serious stuff.
I get it. I'm just trying to explain the chart more than anything.
Yeah.
In terms of that extreme bearishness, I mean, this is a percentile of those looking for growth expectations plus cash and equity allocations as well on the scale.
Your outlook for the future.
Right. So, but are you surprised to see it this high? Given, but just given the market valuation and everything, it doesn't seem to me that this chart adds up a ton.
It doesn't seem to
in terms of the sentiment. It doesn't seem to add up in terms of price action to what this sentiment is. It feels like this is taken in a bubble to me. Just when you look at how if I was to overlay a SPY chart with this, I don't think that it would match up one bit.
No, it'd be the opposite.
Right.
The lows would be at the lows. That's what sentiment data is. Right? Well, everybody gets bearish at the lows, baby. That's what we do.
Yeah, no, I get that. But what I'm saying is that given how we've just been moving within the markets here, I would have. I mean, look at the AAI or the AAII data, right? With the bulls, that's moving back towards highs, right? We had that run of 40 inside of it where I would have think that we would have had some more spike ups higher, like during the summer months when we were seeing a nice rally post SVB.
I bet you will next month. This data was distributed over a period of 15 days.
Right.
My guess. I mean, people are still going to be, I guess, not that quick to transition in the fund management world.
And that's kind of the point of this slide, right? In terms of that we haven't seen people catching up yet with the market performance, which points towards the money that there's work to do. There's money on the sidelines. And that's my point in terms
there's no doubt about that.
I would have expected this to be up near those tax cuts or blue wave or BRICS or QE1.
Imagine when good news
numbers that we're seeing. Yeah, exactly. And that again is to the point of that there is some upside here in this move.
Sure.
Cash off the sidelines. This is definitely popped with that market, of course, moving from 5.3% to 4.7%. But again, there is still room. You can see there's been other time frames, mid 2009, 2011, following the European debt crisis, 2013, where we have pulled, where we've seen that number slip below 4%. So this is lowest cash level since 4.2, right?
Yeah.
So lowest cash level since November 2021. So certainly it reflects the move that we saw in stocks over the first part of November.
Well, bonds, right? They said the highest confidence position was flows into bonds.
Right. So that money is, while it's coming out, has not necessarily been going to equities. Again,
well, right. The thing that people seem to be most confident about is the top end rates.
Right. And again, that just kind of points towards the idea that there's still money that could be put to work here, be it either coming from different asset classes or from off the sidelines still. So,
Sure. And just to echo that further, yesterday was the first day we had a real break in the put call.
right.
I mean, before yesterday, it just stayed up there. We had half of this rally was sitting at 1.1, 1.2. So
Yeah, and again, that's all part of the derivatives that are in play here, that
and we're
are
still betting
impacting the
against it.
way,
Yeah.
and everybody's still betting against it, like you said, right? So, just another slide that shows you that there's still some more work that can be done here to the upside. That's kind of the big question I feel that's out there, right, Brett? Like, have we hit the end of this? Is this a bear market bounce, and this is the end of this rally, or are we going to continue into the year end? Um, Now, here is one aspect. We're starting to see the first overweight in equities for the first time since April of 2022. Last time we saw fund manager survey rotate back to overweight equities for the first time in over a year. That was the start of the 2009 through 2020 bull market, the longest
It's
bull
just the
market in
start.
history.
Yeah.
So you could see that, yeah, things are improving on that front, but boy, there's some room to run on this too. I mean, the last couple of years looks like 2009 again. And to your point, Brett, there's nothing really that suggests that it should have been looking like that. It's certainly a change in rates was raising some questions on how this new regime would work. And that led to a little bit of protectionism. Certainly, people were so overweight stocks probably at that point too, and finally were able to get into money market funds and other areas that were returning 5% that they started moving in. But now people moving back into the equity side of things.
Yeah, right. I mean, this is it's just one of these sea changes. And now this would have to be just a one-off head fake for that to not be something, I mean, obviously we respond to that. If that's what it turns out to be. But at this point, like this is we've had these guys underweight equities all year. And to the other conversation Gavin broached at the beginning is this idea of, we're coming into year end. We've got 6 weeks ish left. And you can see what that chart looks like right there. These guys have been underweight equities the whole year, and the Nasdaq's up almost 50%. Like your career's based on benchmarks, and it's a mortal sin to trail the market in a bull market. So what are you going to do about that if you've got 6 weeks left in the year? Like I don't see a whole lot of selling going on
No,
for
it,
on Wall Street. Like what are you going to just ramp up the high beta, right?
well,
I mean, what do you do?
exactly with the high beta, Brett. And you saw that with that rally
These
that
small
we
caps,
got on Monday.
maybe. I don't know what
Small caps, renewables that were a big winner. Non-profitable tech names, Arc
something.
Innovation, that's had a big rip. So people, the
Regional
AI
banks,
names, yeah, regional banks, all these were the big winners as soon as that CPI data hit on Tuesday, and it went to show you where people thought they could still get returns because mega cap growth that was trailing, right, Brett? I mean, it's going to be tough to squeeze that lemon a lot further.
seems like it, right?
Right. I mean, who knows? Maybe we get those looking like internet stocks of the
Oh,
2000s.
maybe that could be the barbell, but still, these guys have been underweight the whole year, very plainly. And it just seems like there's no way there's a lot of people who are really comfortable right now with their returns this year.
Yeah, and they're going to have to look to try to juice them up too. So that's going to be a lot of risk being put in, a lot of chasing, I would think, right?
Yeah, that's what I can't understand another version of reality right now.
Yeah. I mean, certainly there'll be red flags. You never know, geopolitical tensions flare up or whatever. Maybe we get a couple of big hot inflation readings that rattle the market right now. But as we've talked about, the market valuation, sure it's rich. Sure, we've had a big run, and but we haven't seen anybody looking to leave the party yet, right? All last week was a consolidation until we got to Friday, and then we ripped higher. And that was in the face of a pretty high U of M inflation number, right? Then you saw CPI, like any sort of hint of good news, and everyone's been ripping these higher,
The competition, yeah.
and you're not seeing people banking too many profits at all. So,
So, I mean, it's been too fast. The thing has
yeah.
been too fast.
So moving along here, Brett. Now let's talk about this historical Brett thrust that is going on right now. So why don't you break down this slide for us, Brett, and kind of discuss what you're talking about here?
Well, so I mean, these like each one of these things is like, one of those signals that has like a 95% plus hit rate over the course of 50 some odd years, like every one of them. And they all happened at the same time 2 weeks ago into Friday, pretty much Friday. I mean, you're familiar with this wide breadth thrust, right? Gav?
Yes. Yes.
Yeah. So you got one on the NYSE, you got one on the Russell 2000. The 91% McClellan oscillator crossover breadth thrust is a similar idea. TCTM composite thrust model signals, similar idea. SPY breadth thrusts, obviously. So there were a bunch of these breadth thrusts, and they're like, I mean, like the Zweig breadth thrust has been right every single time since 1945. Like these things are the most reliable signals you're going to get in the market. The VIX 7-day drop by signal is even more reliable, apparently, over a 2-month time frame. So you got 2 months and 11 months as your time frames. Like if you trust the data, and the question is, do these signals degrade over time because they get more popular? And that's an open question to me, because I believe the market does evolve. And in my experience, like you can have situations where the signal wouldn't have been there, except there's a lot of people with a lot of money trying to anticipate the signal happening. And so, as soon as it kind of gets past a certain threshold of partially happening, there's tons of capital mobilized that ends up buying everything in sight, which actually then causes the signal to happen. And that brings up kind of like, a sort of time travel movie paradox. Like, did it really happen then? And I think those sorts of things degrade signals. So I don't know whether that's the case, but we've never had it fail. Still, so it's still got a clean record. So these sorts of transitions where you get these kind of, and again, I want to go back and talk about the context, because last time we had one of these sentiment and flow shows, we were saying, kind of like get your shopping list ready, because we've got this obviously asymmetric positioning situation where you've got this this 10-day put call average at 1.2, which is like really rare, and it's a super strong kind of indicator that there's never ever before been a bear market that starts that way. You get selling, you get people ramping up their put option buying, and we've got it's a large enough sample size going back a number of years where like you're not gonna, it's important data, like it's significant, it's substantial, and there's never been a bear market that comes out of that. There are always corrections of a more minor level that eventually springs back into whatever pre-existing bull market trend was there, like just every one of them. And then you get this signal as well in terms of how we make that low, and it's a very sturdy premise. And then I get to second guessing myself by saying, well, everybody sees the same thing, and but I think that's why we're seeing such an aggressive move in the market right now, is people were just so offsides against something that just was not going to be breakable. And when it finally snaps back, we get all of these model signals triggering kind of all at the same time, because it's just a royal flush. Like you had everybody offsides to begin with and just over pressuring. And then you have this sort of the number of uncertainties that piled up into October in terms of the headline, the exogenous sort of aspect of things with the Hamas-Israel war, Mitch McConnell being booted out of the House, speaker role, at just sort of a series of things. People kind of being offsides in terms of their estimation of Q3 earnings. There was just a pile of uncertain factors that kind of all conspired at the same time and set this context. So I think that we unwound those things, and what was left was just this massive, what I would call a flat squeeze.
Right. Want to address a feedback question here, just because I know it sounds like Brett and I are all bowled up and everything, and we're not whistling past the graveyard. To be clear, our argument is a lot to do with positioning and the market, and you kind of have to remember the market's not always going to be reflective of the economic conditions, and that's what we're trying to emphasize here. It's there's a lot of positioning at play, and a lot of benchmark um, at portfolio benchmarks at work for the dynamic to kind of just hold us up for a 6 week run into the year end. So the person on audio asked regarding sentiment. Oil is broken the 200-day moving average. Copper is very low. China market tanking. These are concerning headlines, aren't they? And of course they are. I mean, that's certainly reflective of expectations for an economic slowdown.
Which is lower interest rates, which is lower inflation.
Lower interest rates, lower inflation, which gets the Fed to where they want to be. The China market tanking, I still think that we're going to see, and we got the decent econ data. I still think that people are discounting the stimulus that's going in there. It takes a while for this to work through. Like we saw it with inflation and the fiscal policies. We started getting them in early 2020, and then through 2021, and it was 2022 where we really kind of ended 2021, 2022 where we started seeing inflation coming. So sometimes it just takes a little while for them to work their way in. So
And the China market, the Shanghai index is up 2% for the last 3 weeks.
right, and that's with the China market tanking, right, all through the property headlines. Copper and oil low, that obviously reflects weaker econ data, but the market also forward looking at instruments. So if there's the idea that this is kind of hitting the trough and some of the economic weakness, and oil's a cheap buy here, let's not forget the Biden administration plans on replenishing the SPR at 67 to 72, which is where we're getting to right now. That's been solid support. So, maybe that's areas where people see underperformance that they look to pile into here. Some of the energy names, some of
Hey,
the
I'm
material
fine with
names.
cheap energy.
Yeah,
Come on.
helps the
Even though I'm
consumer.
long USO, I'm telling you, like I'd be wonderful. I'd be happy. Let's get cheap
Yeah.
energy.
So, yeah. So again, not whistling past the graveyard, but it's important for us to note that the dynamics that we're talking about isn't about some of the economic slowdown. It's about what we see going into year end. We've been talking about this for 2, 3 months now,
Right.
and that was going through some very difficult times when it was, very tough to have the views that we had when everybody was bearish out there. So again, not discounting any of those, and sure they could disrupt things
Is
if
that
we
me or
see
you?
what's that.
Well, you went out for a second. Did I go out?
No, it must have been me then.
Okay.
So but so anyway, so just wanted to address that feedback question.
Well, and I would say also, just to attack on what you said, it's a poker game or an auction. It's not a physical system. What other people are doing matters.
Yeah. Another question. There's an idea that the Santa Claus rally's been pulled forward. Any thoughts there? I don't think anything that we're seeing right now has anything to do with the Santa Claus rally. I mean, the Santa Claus rally for me, that tends to just be a moment of low volume and low volatility where you see bulls kind of easily being able to push around the markets more than anything. The Santa Claus rally runs from uh, Christmas Day until the third or fourth, Brett, whatever that second day of trade, third day of trade is coming back from the new year. So it's possible that we could see this continue and go through, but I don't see this as Santa Claus rally has more for me to do with volume and everything. Everything we're talking about here is more to do with positioning and sentiment. Would you agree with that, Brett?
My kids believe in the Santa Claus rally.
I mean, I'm not discounting that, but I mean to say that this is a pull forward of the Santa Claus rally,
I
to me,
don't know.
I, I,
This is a
I,
dynamic that was embedded in what we were going through over the last month and a half.
yeah. I mean, if that, I could say that this is a that this is a pullback of the by Yom Kippur, right? I
Well,
mean,
it's the next shot across the bow beat down of the Marco Kolonovich, Mike Wilson kind of side of analysis of what we've been through over the last year and a half. Like obviously, like there's a tribe in the money management world that is overwhelmingly committed to the idea that this market it is a physical system, and there are certain laws of motion. And when interest rates get to a certain point, and when earnings forecasts are at a certain point, that there is no question, no matter what anybody else is doing, no matter whatever else is the case, the market must respond by X, by XYZ. And they don't look at the fact that everybody's short with them and the market can't go down. And they just try hard, man. They just plow in those hedge funds. We saw, 4-year highs in short interest last time. Like they did the same thing in March, and they did the same thing again. And both times they were burnt.
yeah,
And when you're on the side of the market that's crowded, especially
especially short side. I
especially
mean,
short side equities.
the whole theory of short is that you're expecting somebody to buy at a lower rate,
Yeah,
right? So I mean,
when you're sitting there with a crowded position on a short side in the equities market, which is the asymmetrically disadvantaged side, and I mean, you can see the sentiment data, you can see the positioning data, you know that it's a crowd, it's a consensus opinion. Like there's only so far you're going to be able to push that beach ball underwater before you have to let it go.
yeah. So let's move forward then here, Brett, and start breaking into the Bank of America Fund Managers Survey, some of the items of interest there. Investors remain cautious, but not as cautious. We kind of showed you a few slides there. 2024 playbook that's rolling out right now in terms of sentiment, soft landing, lower rates, weaker US dollar, large cap, pharma bulls, avoid China and leverage. Of course, we can recall the 2023 playbook was energy and financials and avoid tech. That didn't really play out. So kind of keep that in mind before you just take that to the bank. Investors cut cash. We showed you that. Biggest bond overweight since March 2009. First equity overweight. We showed you that slide. 76% say the Fed rate hike cycle is over. And most believe that there's too much stimulus out there. All right. And then we're going to just kind of go into a quick earnings recap here. Margins have held up pretty well. Markets have been rewarding profitability over growth, which of course leads to the question if this will stymie 2024 growth.
Yeah.
Majority of companies did beat estimates. It was running somewhere in the 73% range. Slowdown in capital spending, CapEx and R&D, highlighted most recently by Cisco and Palo Alto. And markets have penalized misses more aggressively. And again, Palo Alto and Cisco being the latest news. So people are definitely looking at the fundamentals, and that's helping them drive a little bit. So,
For the
but
moment.
again, for the moment. But again, this isn't something that's going to be widespread. We're past the earnings season, so it's not until we get into the middle of January that we're going to get those Q4 numbers. Certainly, we'll be paying close attention to that first couple of weeks of December when we get the busy sell side conferences, see if people are coming out and warning. That's certainly something that could be disruptive to the idea of a year-end trade. But for now, this is kind of what we're seeing from the earnings recap.
It's sober,
What's
but
that?
it's sober, but
It's sober, yes.
if we get something more to this rally, we'll become unsober.
Yeah. So, again, it's more about positioning than anything else. And we're just going to continue to track that until we see something break in that theory. Institutional investors here, Brett. This is institutional investor stock allocation closing the gap with individual investors allocation. Basically, the idea of big money chasing retail, right? And
Yeah.
you can see that's still a pretty big gap. And again, When you look, when we talk about the portfolio managers that have underperformed, it's those people that were hiding in the shells, reading the Wilson and Kalanovich notes, and
Yeah.
now they have to come out and go running, and that's some big money that
It's
can
the
be put to
smart
work.
money having to cash in its ego.
Run after the dumb money, right?
Yeah.
Very very subjective who the smart
Hey,
and
we
dumb
went
money
5
is.
years in the late 1990s that way.
Yeah. So again, this is just, and we're not, you know how we put together these slideshows. We're not data digging to build our argument. We're
No
making
data
our
mining. Yeah.
argument built off the data. It's pretty much the same slides that we show on every month here. So we're not trying to manipulate this at all or anything. We're going from what we're seeing in the data and presenting our opinion on that. CTA exposure, Brett. I know this is a slide that you like here. You could see how low down that is.
Yep.
Just dropping again. The quote unquote smart money really underperforming the broader market here overall. And this is overall equities allocation for the
And that's
CTAs.
from the 9th of November.
Yeah,
That's
and look where the median is. I mean, this is
yeah.
still
Look at the
well below
room.
the
Look at the
median.
room we have here.
And I mean,
It's a tough market to short right
this
now.
is from a Deutsche Bank note. And you could see that. How do you short that? Like Brett said, I mean,
Yeah.
August 2022, we were down at that low. November 2018, we were down there. 2016, it only goes back to
How do
2012,
you
but I'm
hold a
sure.
short?
Yeah,
Imagine if you're sitting short and you weathered this rally, and then you see this data point.
yeah. I mean, it's a scary data point if you're underperforming the market, right? So again, this is kind of what we see in terms of the potential for kindling to really ignite a rally here. Equity put call volume. This is elevated.
Yeah.
Again, taking a look at this, average since 2006 is 0.94. Average since 2010 is 0.85. And let's not forget, this is with a lot of volume coming into these overall
A
instruments.
ton. Yes.
And so it's a stronger read
Great
for
point.
us. And
Great
you can
point.
see 1.2, that's the level that Brett always talks about with that 10-day moving average. When you see
Golden
it kind of
level.
get above that, we're running right around 1.1 right now, which again is above all the averages. So people are protected to the downside. So
Well,
once again,
but
Brett,
also just know that the lows we formed were contextualized by that reading. Like that's one of those points on the chart. If you want to draw red circles every time there's a 1.2 hit at a low, like we went a little bit lower for a couple days, but pretty much, mid-October 1.2.
just every time, right?
Pretty
So
much every time.
again, just something that we're seeing out there that plays into the bulls' favor for this rally. Bond yield outlook, no surprise here. October saw a little bounce in sentiment. Growth expectations still far from reopening, peak of 78%. But just watching this, people are expecting lower rates moving forward. That's one area that things could perhaps get disrupted a little bit. So when you're looking, can the Fed rattle the markets? It can, but again, I don't think it's going to overshadow what's going on with the positioning, because it's going to take, as we know, very strong inflation data to get the Fed to move right now, and that's not something that's going to happen between
You
now
know,
and the end of December.
if I had one boogeyman to sneak into the equation here that would really get me to be nervous about everything, it's if the Treasury. So like what really set off this rally, if you think about the sort of the light switch catalyst, even though there was a context that was pregnant with this rally, in my opinion, there was a light switch catalyst, and it was not the Fed. People are saying it was the Fed. It was not the Fed.
Right.
It was the Treasury's quarterly refunding announcement where they said there's just one more quarter of abnormal supply.
Right.
That was it, because like you got this
And,
idea.
and let's not forget, Q1 is going to be higher than Q4, or Q4 is going to be higher than Q3, or I'm sorry, Q1 is going to be higher than Q4 from the projections too, right, Brett? So they are headlines that they'll have to deal with.
Yes, but their basic idea is they'll be back to normal supply starting in late March, like that, rather than 2026, like that. I think the market was in a place psychologically around this where Treasury is going to be putting out abnormally heightened supply relative to history for quarters and quarters and quarters to come. And they announced, no, it's really just going to be a few more months and then we're done with the elevated supply. And I think that was a huge factor. Um, and, and I think that if that were to be wrong, that comment was adjusted, and we see the 10-year go to 5.3 or whatever, somewhere new highs, and this is not the bottom in bonds, given this chart that we're looking at right now, given how much faith has been put in this, that you're going to see bond yields come down next year. You're going to see a disinflationary trend in terms of yields. I think if there's one Achilles heel to the situation, it has to do with that. Now, that's maybe not something that can happen in the time frame of a year-end rally. So it may not be relevant. And I'm not super bullish about next year anyways.
No.
So I'm bullish right now.
I mean, let's not give away 2024's playbook, but Brett, what we just had to kick the can down the road. Stopgap funding bill that comes up January 19th, which is of course right when Q1 earnings season's going to start hitting, and it's an election year, right?
Yeah, if that's a big turd.
And not just in the US, I think it's something like 62%, I believe, or something of the world's GDP has elections next year. So it's not just the US.
I mean, it's just horrible. Like,
yeah,
given the backdrop, like, how does that end up good?
yeah, exactly. So, I
Get
do
your
see,
purge weapons ready.
yeah, I do see the ability for us to rally in a year end, and then, definitely some profit taking going on towards the last couple of sessions in the year, and then the potential for the exact opposite of what we saw last year, in terms of, instead of selling off during the Santa Claus rally and then rallying like crazy in January through February, we could get the opposite going on.
Yeah. Right.
So, FCI improvement is Goldman Sachs Financial Conditions Index. It had the 30th biggest single day improvement since 1990. This was on Tuesday after the CPI data. So
His
again,
pal is just angry at. He's just frowning at that. He's got
that's a tailwind for the broader market, though, and certainly why you saw a lot of those interest rate sensitive stocks.
And we didn't
really
see
rip
Fed
higher.
funds futures move at all. So
No, yeah. So, and most of the occurrences you could see on these pops are around 2008 and 2020. Again, we're really not quite at those levels, so it's pretty crazy to see that.
yeah.
All right, just kind of keeping with bonds here. Bonds top the lists of what they expect to perform the
These are the
best in
charts that
major
worry me.
asset classes. So that's always people probably talking their book, right, Brett?
Well, I mean, just saying, like, these are the charts that worry me. Like,
Yeah.
dude,
So
yeah.
So, I mean, everyone's pretty sure on that. So nobody's looking to stay in cash. So, this is just kind of food for thought. Bond ownership, Brett. So we just saw what's going to be the best. So the question is this just people talking their book? You see the last time we saw bond ownership with like this high was March 2009. It's the third largest overweight rating in the last 2 decades for bond ownership, which kind of makes it odd that bond prices have been so poor. No,
Well, it's recent, right? The
so
spike,
I guess so in terms of just flipping from
that
not
bar
buying,
just
but
happened. That's 1 week,
well, I
right?
mean, you look at it. I mean, this looks like it goes back to the middle of 2023. I know it's not the cleanest chart, but looking where
Yeah, I see
2021
what you're
is,
saying, but it went positive, but that
yeah,
take that bar out and it's not nearly as positive. Yeah, I get what you're saying, that there's
yeah,
been some, I mean, obviously you're talking about relative returns and interest rates have gone up
yeah,
and there's free money there. And we've seen inflation decline, so you got real rate return. You just don't have enough to stop the interest rates from moving higher so far. But yeah,
Yeah.
I'm worried about this whole situation. It just,
So something to track. Then a few Fed slides here. Services ex food, energy, shelter lowest in September 2021. You can see when we talk about the trending in the right direction. Fed balance sheet. There was a discussion earlier with Cook and Kugler and Jefferson about where it will be. They haven't named the level. I mean, usually they try to get it in that 4 to 5 million or 4 to 5 trillion range, I should say. You can see that is coming down. It did dip below 8 trillion for the first time since around July of 2021. So slow progress. This was something that I found interesting, Brett. We were posting this around the Silicon Valley Bank item, and this is banks using that facility there. Now, we talked about this being perhaps just something where it is just such a useful facility for banks that now they're gaming the system. But steadily going up. Does it have you worried at all?
No. They've taken the stigma away.
Yeah.
It's cheaper money.
I just found it interesting because I was just kind of going through the old slides, and when I saw
they did a great job of removing the stigma.
Yeah.
Right?
Right.
Now, I mean, that's such a great thing, really. Honestly. I mean, maybe it will be too great.
Yeah.
It will.
I feel like it's going to blow up at
some
point,
way, but like as far as dealing with a regional banking crisis, it's a great thing.
Yeah. So they still continue to access that facility, obviously. This is interesting. Fiscal stimulus, too much out there, just kind of going into the political realm in 2024. It'll be interesting to see how people view commentary and, can a candidate get ahead, Brett, with the idea of raising taxes and lowering spending because they're going to take care of the debt issue.
You know what? I've got about 50 bridges to sell you if you think.
I get it, but it's so crazy when you see it.
I think you're ready to run for office, Gav.
Right? Well, obviously, my platform's not going to get me elected in too many areas, but so anyway. Just interesting to kind of see this. The last time, April 2018, that's of course when the tax cuts were probably put into place without much need. November 2021, that would have been the second round of stimulus and following COVID, where people didn't think that it was really necessary. So, both sides of the political spectrum got whacked on that. May 10th would have been, of course, when the Fed was still doing a ton despite the market rallying. So
this is like one of those questions where it's like, do you think free money is bad, or do you think people should have access to good food? In the very abstract moment, some people might say, yeah, to that. But then anytime it has to do with a real life reality, obviously not.
Yeah, that changes. All right, taking a look at geopolitical. What's the biggest risk here? Geopolitical risks are the top, so you can kind of see the progress on that.
You think that's winter in Ukraine?
Or
Saudis? Or Israel?
I think Israel, right? I mean, the
I think
Middle
they're
East
tied.
more than anything.
Tied. I think
the
there's
Ukraine
an idea
is so far off the front page, though. Right now, I don't really see people thinking too much about that. And if Napoleon taught us anything, it's never do a mission in Russia in the winter, right?
In Russia. Yeah, it's awesome.
Winter land wars in Russia do not work.
Yeah,
just ask Hitler and Napoleon.
Right.
So I think that's all Israel.
I think they're tied. I think this is a coordinated thing a little bit. And I think that the idea that you get this sort of like the U.S. has to divert resources in two places coming into the winter, and then you get, Russia kind of cutting off the gas. And Europe then saying, you know what, maybe wavering on how, are they really going to just be all in? We've got to defeat Russia, get 100% behind Ukraine. When
it's possible. For my money, it's the Middle East and Iran.
From food standpoint, there's a sweet spot there.
Yeah.
if you coordinate all that together. And I feel like the winners win. That would be,
Yeah. Yeah, no,
happy.
I mean, look, none of it's particularly good, right? So, it's all, and I think too, with inflation cooling off, people were probably looking for the next boogeyman, and that makes
Yeah, that's a good point.
most,
And again, I hate this data point for
yeah. When, and
biweekly
what's
commentary. I'm
funny is
hating this data
global
point.
recession comes in third with a hard landing. Yet we saw the numbers before that most people expect a soft landing. Systemic,
People don't know what to say. There could be a confidence interval of like nothing on all of
yeah.
these answers.
But what's also interesting too, we're talking about that China slowdown. Yet here we see the China real estate bubble falling off the front page, right? So,
Yeah.
all right. Then just wanted to show this tech versus banks. If we're looking for an area where maybe people try to make up some of the underperformance,
Catch
perhaps
up.
we try to rally some of these regional banks here against tech, and this that percentage of overweighting, it's the highest it's been. In about 3 years here since around the great financial crisis or the COVID issues. So, it's just something to kind of watch. And then finally, a Magnificent Seven sentiment. This is from a JP Morgan note. Are you more or less inclined to be long to Magnificent Seven stocks? You can see a lot less people in there. Does that mean that it's going to take uh, all the money going forward into that year-end rally?
You
Uh,
know,
it still possibly could. I mean, perhaps people talking their books and trying to talk people out of this, but just kind of watching this makes you wonder how many
do you,
people will be looking to chase them.
Gap, do you know who are the respondents to this survey?
It's all JP Morgan
Is
clients.
is it like high net worth investors or is it prime brokerage clients?
I think it's primarily prime brokerage. I'd have to double check on that to be honest.
Okay.
So, all right. So we are just about running up on an hour here. So Brett,
Yeah.
my basic take from the discussion is, we've held fast, we've held steadfast going in with the idea of a year-end rally, and
Yeah.
obviously it was very difficult to kind of eat our crow. The last sentiment and flow show, we stuck to our guns. We did note
Did we
some of the
eat our
issues that were.
crow?
Well,
I don't recall having any crow.
we definitely weren't looking bright at the end of October when we were
But were we
last.
saying, this is silly? There's
Yeah, no,
definite things that say
we
a big
stuck to our
burst higher is
guns, is
coming.
what I'm saying. We stuck to our guns, but
Yeah.
we were aware of the issues that were going on.
I think I
But
had
no,
a delightful crow sandwich. It was tasty, well
yeah,
seasoned.
no crow on the turkey dinner at this point, right? Barring any major
Uh,
mishaps. But as we kind of went through the slides again, we don't take the slides to build our argument. We look at the slides
we
and
use the
then
same data
take
points
our
every
argument.
time,
Yeah.
which means you
Perhaps
can't
we'll
handicap
grab something that looks interesting. So this isn't just reasserting the data to help our argument. This is just what we're seeing out there. Does it last into 2024? Oh, that's a big question mark. I mean, at this point, I think this is more of a year-end rally that gets kind of a shakeout in the early part of the year. But there's definitely a lot there that suggests that there is some more room for upside, is my general takeaway. But Brett, I'll let you surmise it in your words as you do a much more eloquent job.
So I think we've had a pretty firm kind of grounding in how we've looked at this whole year. Um, um, Really, that we've had a, a year that is remarkable from the standpoint of sentiment and positioning data. It really is. This is not a common year. I've been looking at this data forever, and this is a weird period where, like we were talking earlier, that there's just this remarkable kind of built-in bearish instinct to all the splash money in the market. There's a bedrock of a foundation of investment capital that's a lot harder to move, but the money that's easy to move is easy to move to the bear side of the equation. Every time you get that, just anything, just 1-2% down day, and it just floods that direction. And we've seen this over and over and over again. And we've kind of had some commentary about why that is. But what stands out is that it keeps being a really bullish opportunity. When you're looking past that and you're seeing the extremes, and you're seeing why everybody's loaded up on puts at the same time, and the market can't seem to go down, or at least not dramatically, and you get some positive technical signals, and then boom, you hit the other side of that. And we've seen a number of really dramatic kind of rallies, and this year, and this is the most dramatic. I mean, we've seen some others. We've had some right out of the gates. Again in sort of mid to late March, and certainly again in June. June was a really dramatic rally. And they've kind of all been contextualized by the same sort of situation where people just go through a process of getting really, really, really bearish and bearish positioned with every loose dollar. And this one triggered a lot of key long-term buy signals. The breadth thrusts. We've finally seen some real breadth come back into the market, and some volume, and and now we've seen the flip from underweight to overweight among fund managers, which is enormously important to see that kind of shift. There's a sort of sponsorship there, and there's a sort of game there. There's a game theory landscape that puts them in sort of behind the 8 ball into year end, I think. In my experience, in moments like this, you can rely on Wall Street to chase when there's careers on the line, when there's the need to outperform benchmarks, and you're trailing. And so there's this high beta kind of direction to this. And I got a question from somebody about oil. Gavin, if you want to respond to this after I do, just the idea of what oil is doing, but like Gavin said, yeah, you've got this SPR issue for the administration, but oil is acting really poorly, and I'm long oil now. I've taken profits 3 times on my long oil position. I want to be clear about that, and so this is kind of like the Nasdaq position. The last time I took profits was almost exactly at the highs of the last several months. So it kind of gives me more of a sense of my, trying to kind of stick it out with my longer term position, because my longer term position is oil's massively structurally undersupplied. And it is. It's cyclically a wild card, but it's structurally massively undersupplied. We just simply haven't invested anywhere in the world in terms of building out production capacity for oil over the last a long time, right? 15 years of not investing anything anywhere really in the world. And this has all been this energy transition overhang, this sort of looming dark cloud of this energy transition. And really an oil investment is a 50-year payoff. And you get massive capital together from, nation level investors. And you're talking about an intergenerational kind of investment horizon. And it's tough to do that if you think that there's only 10, 15 years left of like a fossil fuels industry. And so, the question is, can we beat the clock? Can we find alternatives? Is fusion going to somehow come through fast enough? Are we going to piece together a patchwork of nuclear and alternative to make up the difference as the oil supply starts to peter off? Because the production capacity needs to be reinvested in regularly to continue the spigot. And so, when we get to 2028, 2029, 2031, is that just going to leave a gap where, every barrel of oil is worth $500 because we haven't invested in it. And so you've got this fundamental mismatch in supply and demand. So there's a structural time horizon to me being interested in oil from the long side. And I've got a runner position. I've got a final position. I've got a final piece. And, but right now it looks like the cyclical winds are really pushing against it. And that's probably a sign of just global slowdown. And probably China's a big factor in that right now. The way that it's behaving is bad. I'm not going to add to the position. I would, if you saw me in a position where I had a lot of confidence in the piece that I have left, I would be adding to it into this decline. It's just in a mode of behavior that looks really not constructive at all. So I'm willing to let that play out, however it plays out, and just kind of reassess as it evolves. I don't obviously, if I wasn't long, I probably would have been looking to short into the last bounce. So there's some negative to my positioning in this situation, but yeah, I mean, the way it's behaving is dreadful.
All right. Well, I think that's going to do it for us then, Brett. As per usual, always appreciate you jumping on audio. Always find this conversation to be pretty stimulative. Hopefully, everybody else found some use on it and some value. And I'm going to be posting the replay in a little bit. But Brett, let you get back to taking care of that cold and taking care of the kids as well.
You got it, buddy. Thank you.
All right.
Take
I'm
care.
going to be shutting down audio just for a moment here. We'll be reloading it in a little bit and jumping on for the market close here in a moment.
All right. Take care, Gav.
You too.